First up on the agenda, we have an introduction on portfolio construction. And to do that, we have Johannes Stroebel, who is David Loeb Professor of Finance at NYU and also the team leader for the VRI's climate initiatives. Johannes, please start.
Perfect. All right. So thank you very much, everyone, for tuning in, and it's great to see so many, coming to the VRI to learn more about, climate risk and the interactions of climate change and financial markets. What Dig and Rob asked me to do is to start out with providing a whirlwind tour of what we have learned on the academic research side in this topic, climate finance, and the interaction of climate change in the economy. Those of you who followed this closely, the past few years have seen a really unprecedented surge of academic research studying the intersection of climate change and financial markets. And a lot of this research has been done by researchers here at the VRI and at NYU Stern. And so a few months ago, my co-author Stefano, Bryan, and I were asked by the Annual Review of Financial Economics to provide a review article summarizing what we have learned and where do we need to go from the academic research side over the next few years to push this climate finance agenda forward. And so what I want to do today is just give you sort of a brief summary of how we approach that review, how we approach sort of that, overview of where the research has led us so far and where we want to go. It's going to be very brief given the time constraints, but you'll find the paper on my website if you're interested in following up on any of these aspects further. So in the review, we focus on two specific aspects where the academic literature really has made a ton of progress. The first question that the academic literature spent a lot of time thinking about is how to model climate change in our standard asset pricing models. And so what I'm going to do today is just give you a heuristic overview of how we think about the different approaches that the literature is taking on this. The summary paper has a formal treatment, and we also have a paper coming out in the RFS that also spends more time thinking about this. So when you think about how to incorporate climate change or climate risk in asset pricing models, from our perspective, really the central questions that you need to address is, first of all, what are the main sources of uncertainty in the economy, and how to think about the feedback between climate change and the broader macroeconomy. There's obvious ways through which the economy affects climate change, right? Economic growth produces carbon emissions, which affect climate change. And then there might be a feedback loop from climate change to the macroeconomy, and how exactly you go about modeling that relationship has really central implications for a lot of really important questions, in this climate finance space. So broadly speaking, and again, this is a heuristic overview, the literature is taking two different types of modeling approaches to this question. The first modeling approach is one where you would, broadly speaking, say the main source of uncertainty in this asset pricing or macro finance model will be about the economic growth, right? So economic growth is the main driver of climate change. And the way these models approach including climate change in the more standard modeling framework is by thinking about climate change as a tax on consumption. This could either be a constant tax, or this could be a tax that's increasing with the amount of economic growth. But centrally, the relationship that these sort of asset pricing models generate is that when you have more economic growth, you have larger climate damages. And what that essentially means is that states of the world with lots of climate change, lots of climate damages, are actually states of the world with relatively high output and high GDP, right? Because it's exactly that high output and high GDP that causes the climate change and the climate damages in the first place. I'll talk about why that matters in just a slide or two, but I just want to start out by saying this is really the basic approach that's taken in much of the early DICE literature. Bill Nordhaus will be with us later on in the day. His sort of pioneering work that's won him the Nobel Prize really takes this approach of incorporating climate change and climate risk in modeling. There's a second approach that people like Robert Barrow and Marty Weitzman and others have pushed, where you think about including uncertainty about climate change directly into your models. So it's not just coming as a result of economic output, but you can think of climate change or climate risk in these models as a relatively low probability but catastrophic event that by itself could directly impact the overall economy. And in these models, what happened, and the probability of this disaster can actually increase in economic output. So it can be after more growth, after more carbon emissions, we have a higher probability of this climate disaster happening. But really, in contrast with the prior model, what you're going to get in this modeling approach is that states of the world with lots of climate change are actually states of the world with low output and low GDP. Because that climate disaster by itself pushes the economy in that direction. Now, why did we think that when we were reviewing this model, these various modeling approaches, this was really the central distinction between the ways that Barrow and Weitzman approached this issue versus the way that Nordhaus and others approach this issue? It's because one of the central things, and I'm sure we'll see this pop up throughout today's talk, one of the really central object we're thinking about when thinking about regulation, when we're thinking about things like the social cost of carbon or cost-benefit analysis in the climate space, is what discount rate should be used to discount in the benefits, the future benefits of investments we make today that mitigate climate change in the future. It seems like a fairly straightforward question, but actually, these very different modeling approaches lead to very different answers. Why? Well, we know from basic finance theory that the appropriate discount rate for any stream of cash flows is, the sum of a risk-free rate and a risk premium. What is this risk premium? Well, this risk premium is positive if investments, are what we call risky. Technical terms, they have a high covariance with the margin utility state of the world. But basically, investments that pay off in good states of the world are less attractive than investments that pay in bad states of the world, because in good states of the world, we have a lot already. And so getting a bit extra payoff isn't that valuable. Now, if you follow the assumption 1, where climate change primarily happens in good states of the world, discounting the benefits from climate change will include a positive risk premium and a high discount rate. On the flip side, if you take the second modeling approach, where climate change itself can push the economy into these bad states of the world, you're going to investments to mitigate climate change actually hedges, right? They pay off primarily in bad states of the world. And hedges we really, really like because, when we're really badly off, have a high margin utility of consumption, that's when they pay off. And in those worlds, the discount rates for climate mitigation investments should actually be below the risk-free rate, have a negative risk premium. The intuition here is very, very simple. And very similar to the basic capital asset pricing model, a CAPM model that we teach in introduction classes, in MBAs and undergraduate programs, where we think of risk as being the covariance with the overall economy. And you might recall that in these models, stocks that have a negative beta, stocks that pay off when every other stock doesn't, they actually have an expected return and therefore a discount rate less than the risk-free rate. So depending on which of these two modeling assumptions you take, you start ending up with very, very different implications for the discount rates to apply. You can be anywhere from 2%, 1 to 2% if you take the Barrow-Weitzman approach, or 6-7% when you take the Nordhaus et al. Approach. And those will lead to orders of magnitudes difference in terms of the social cost of carbon that comes out of it, how much we should, and also if you're thinking about, how to price assets in financial markets that have a lot of exposure to climate risk, how much we should worry about that exposure to climate risk, right? So, that's why we thought from a modeling perspective, this was really the central distinction in terms of the implications for asset pricing and for financial markets, because the two approaches give you a different covariance property of climate change with the overall economy. Now, there's a lot of details that I'm abstracting away from in this, 8 or 9 minute review of, literature that's been working for 20 or 30 years, but it's really the central part from a financial perspective that, that actually a lot of the early research coming out of economics departments and coming out of, environmental economics research groups didn't pay as much attention to as, we think it should, because from a lot of the important questions we're after, how much should we spend today to mitigate climate damages 50 years from now, right? That discount rate is the central object. And we all know, again, that, a discount rate of 3% or 8%, compounded over a 50 or a 60-year horizon, or even a 20-year horizon, gives you very, very, very different valuations. So that's the first part that we talk about in much more detail and, a bit more technically in the review paper. How do you think about modeling climate change in these sort of standard or more standard asset pricing models that we would write down. The second question is an empirical question, and again, this has really been a part of the world where the literature has made an enormous amount of progress over the last few years. Again, to some sizable extent, driven by research done by people at the VRI and at NYU. The question is, how much is climate risk already priced in asset markets today? Now, most of the approaches that think about this question start from classifying assets within an asset class in terms of their exposure to climate risk. And you all know that there's various ways to think about climate risk. There's physical climate risk, there's transition risk, and some people split transition risk further into technological, regulatory, legal, etc. risk. But broadly speaking, you want to think about different assets within an asset class in terms of their exposure to these risks. Now, what the most important risk source is largely depends on the asset class. Right? So when you think about real estate as an asset class, or you think about mortgages which are backed by real estate as an asset class, exposure to physical risk seems to be the first order concern that you should worry about. Things like rising sea levels or wildfire exposure, hurricane exposure, etc. Right? And in an RFS paper together with some co-authors, I've spent a fair bit of time thinking about how to quantify the physical risk exposure of different down to the individual property level, and how to then aggregate that up to think about risk in mortgage portfolios, etc. When you think about equities, I actually think, largely speaking, when you think about the overall sort of valuation, sort of value-weighted exposure of the U.S. stock market, I think we're much more thinking about transitional regulatory risk, largely through things like the carbon intensity and the potential for carbon pricing, etc. down the road, rather than true physical risk. So, again, we have a paper with Rob and co-authors in the RFS last year that, takes an approach to quantifying the differential exposure of different stocks to transition risk. Margin's presentation later on will also take a related approach to think about differential exposure of stocks within, within the equities asset class. When we think about municipal debt, again, I'm thinking largely of physical risk. Why? Because municipal bonds are, the tax base that is that's going to be used to make the payments on municipal debt is very local. So municipal bonds on the on the North Carolina or Florida coastline might have much more physical climate risk exposure than elsewhere. Regulatory risk exposure there is less obvious, though if you're thinking about municipalities in very oil-rich regions, you might also think that there's some transition risk exposure there. When you think about sovereign debts as an asset class, you can think about both physical and transition risk. And again, it depends on the country. When you think about countries like Bangladesh, Fiji, etc., so countries very low lying, Singapore, etc., rising sea levels seem like a very important physical risk exposure that you want to think about with sort of sovereign debts for these countries. But then you have a whole other group of countries, UAE, Norway, etc., where a large amount of the government revenue comes from tax revenue that's related to hydrocarbon production. And again, these types of countries you want to think about as transition risk. So again, first thing you want to do is which type of risk you have, and which and presumably you want to focus on the one that's most important, which as reviewed here differs across the asset class. And then the second question is, how do you measure these exposures? Right? So physical risk exposure is a little more straightforward because we have largely borrowed from our colleagues in the physical sciences. We have models of climate change effects and how the geographic distribution of these various climate effects, rising sea levels, etc., will differ. So NOAA is producing maps of sea level rise. There's private providers that do this, but this is really not something where the finance profession has a comparative advantage, and we borrow from what our colleagues in the physical sciences do. And then you can combine that with the locations of different assets. Now, for real estate, that's pretty straightforward. So I have a map here from one of our papers where we geocode, properties. This is, Miami, and then we overlay that with the, the maps of rising sea levels provided by NOAA, et cetera. And you can, at the property level, figure out, conditional on this, projection being correct, which properties will be flooded, which ones will be not, and you can start thinking about physical risk exposure at the real estate asset level that way. When you think about equities, it's a bit harder. Right? Now, I said before, I don't think physical risk is the first order risk to worry about with equities, except for maybe a set of agricultural companies or something like that. But largely speaking, production facilities or physical capital is a relatively small part of the overall valuation of the S&P 500. And so maybe physical risk isn't as important. But if you're going to go down that route, you'll have to take approaches like mapping out the location of all production facilities and then trying to figure out what the risk exposures at these locations is with similar, physical risk models that you have. And you can go further. You can try and figure out not just the firm itself, but what is the physical risk exposure of its supply chain? What's the physical risk exposure of its client? So, depending on how important you think that physical risk is for the specific equities, there's a much more you can do here. Transition risk is, is something that's, that's I think a little more tricky to value, right? And it depends on things like the business model, right? The ability to measure transition risks, if you think, for example, that a lot of the transition risk comes through increasing prices of carbon, whether or not through a carbon tax or other methods. What's very hard is to actually figure out at the asset level what the carbon intensity of a business model or a specific business is. And we're going to have a session later in the day that focuses on how to improve these disclosures at the firm level to better understand the firm level transition risk exposures that you can then aggregate up to portfolio level, etc., do stress testing and all these things that we'd want to do to kind of probe the systemic risk implications of it. ESG scores are an approach to take. So in the paper with Rob, we we tried to figure out the extent to which the E or a subset of the E parts of ESG scores provides you at least an imperfect proxy of transition risk exposures, and it goes somewhere, but it's obviously not perfect. What you can also do is you can analyze things like 10K statements, earnings calls. So these are all approaches that people have taken. How much does the management team, either in the earnings calls or the 10K statements, talk about physical transition risk? Now, importantly, a lot of these physical and transition risk can be both positive and negative. So you could imagine, certain real estate portfolios, if you think you're buying, frozen land in Canada, that might actually benefit from transition risk, right? If the world gets physical risk, right? If the world gets warmer, those frozen lands might actually become more valuable. On the equity side, it's more obvious, right? Renewable energy companies, your Teslas of the world, etc., might actually benefit when there's a carbon tax and a higher price of carbon. So again, these risks can be both positive and negative and something you can exploit. And then lastly, these risks aren't time invariant, right? So to the extent that business models matter, the same company can change its business model quite often in response to shareholder pressure. And so to the extent that firms adjust their business models and sort of in a forward-looking way, the carbon risk exposure of two different oil giants might well be quite different depending on how much their business strategy over the next 10 years calls for investing in in more renewables, etc. So again, it's not a sort of a fixed characteristic of an asset class, but it moves on. And then the last thing is you then, once you have these exposures, there's two approaches then to asset pricing. The first one is that you can, compare the expected returns of the prices of the more or less exposed assets, importantly holding all other characteristics of factor loading fixed. Now that's really challenging. On the real estate side, you actually find that those properties that are more exposed to rising sea levels in the levels actually more expensive than those that are less exposed. Why? Because they're by the beach. And so there's something else, the amenity of being by the beach that affects the pricing that's correlated with the climate risk exposure. And so that's very hard. If you do the same in equity markets, again, you need sort of to perfectly control for all other factors in order to look at the pricing of climate risk this way. A second approach that you can do, and I think it's one that's very promising, is you can assess the returns of these portfolios, with more or less exposed assets, when there's news about climate change or changing attention to climate risk. So what we did in our real estate paper is we measured the attention to climate risk at a very localized level of a real estate market by doing textual analysis of the property listings that realtors put online for these housing markets. And so what you see is that even within the same housing market over time, there's some years when everybody talks about, this property is high up, high and dry, won't get flooded, usually after hurricanes. So when, local buyers' attention to climate risk is very big. And then there's other years where, that attention to climate risk in real estate markets is much lower. And what we could show is that while the more exposed properties as at a level actually have a higher price than those that are less exposed. When there is news or increasing attention about climate risk, you actually see the property values decline among those properties that are more exposed in a differential, say. And so then, that allows you to get rid of some of these constant differences. You have the same issue with equities, and at a national level in this paper with Rob, what we looked at was trying to, look at news about climate change from the Wall Street Journal coverage. Now we're talking about national news rather than localized attention. That's something. Now, once we understand climate risk exposures, what can we do with this? What's actually nice is that we can hedge it. So, in a paper with Rob, what we showed is that long short portfolios on E-scores. So you go long firms with high E-scores, you go short firms with low E-scores. Heuristically, you go long the green firms, go short the brown firms, but actually most of the variation is within industries, and it's in a somewhat subtle way, will actually allow investors to hedge the arrival of bad news about climate change. So when there's bad news about climate change, as measured through the reporting in the Wall Street Journal, to give you an example, what we found was that, those portfolios that, overweight green stocks and underweight brown stocks actually outperform. So there's a way, once you understand these exposures, you can actually try and use these exposures to hedge the risk somewhat. So, this is, again, I was mentioning a whirlwind tour. Each of these papers obviously has a lot of subtleties, and each of these topics has a lot that I think we want to understand better. We've seen a lot of increase of growth of knowledge in this space over the past few years, but I really think we're only getting started, and there's much more work, both on the topics that I discussed before, and then on topics that I think people aren't thinking about in nearly as much detail yet. So I think there's a lot of work that can be done, and we're thinking about some of it ourselves. But when we're talking about these hedge portfolios before, this is all using existing assets, but there's a lot of scope for financial innovation to produce assets that allow us to better share and hedge climate risk. And I think there's a lot of work that can be done there. There's a really interesting question/debate going on at the moment about the extent to which monetary policy should incorporate climate risk concerns in monetary policy decision making, and how to possibly make that consistent with existing mandates and so on, or maybe even if mandates need to be expanded. So I think that's a really interesting debate, and I think something that economists and finance researchers can contribute to. I think in the end, an answer to that question will depend really a lot on this third point too, which is, yes, there is climate risk in the economy, but to what extent does it actually create a risk for financial stability? And in a report that Bob Litterman chaired at the CFTC, Bob will also be involved later in the day, and that I also contributed to a little bit. One of the central things was it really depends on who holds this risk in the end, right? How concentrated is it? In some sense, if that first bullet point here works very well, you have good financial innovation, good tools to share this climate risk, to hedge this climate risk, it becomes much less of a financial stability concern. And so, at a next step, once we understand asset level exposures, really the big important part is going to be aggregating that up to portfolios, figuring out how dispersed it is, doing stress testing, which is again something we'll talk about later today, to really figure out how much financial stability implications there are from climate risk. So that's all that I wanted to talk about today. If any of you are interested in following up on any of this, we have the underlying academic research on my website, but you can also reach out to me, or Rob or Dick by email. I think this is, a really important topic, and we're excited to have you here today as part of this conversation on this issue. Thank you.
Well, thank you, Johannes. That was terrific, and it's interesting to follow how this is taking different roles in different asset classes, and it's a very nice overview.